The best voices will tell you the impact of the Fed's decision on the Indian markets. So we will have the likes of Adrian Mowat from JP Morgan. You just heard Samir Arora of Helios Capital as well. We'll also get R. Sukumar of Franklin Templeton Investments, Vibhav Kapoor of ILNFS, and in just a bit from now, Sanjeev Prasad of Kotak Institutional Equities will also join in.
Okay, well actually Sanjeev is with us. Good morning, Sanjeev Prasad. Thank you for joining us this morning. Well, what do you make of the impact on emerging markets? At the moment, we see a mild shade of green on most of the emerging markets. Nikkei, of course, is up 2.2, 2.3%, but the other markets are up about 0.25%. So should we expect that it's just a little bit of short covering and emerging markets are not going to find too much favor in the days to come as well?
Well, my sense is, this was on expected lines, and even the commentary is, what most people assume that, you will see about 3 to 4 further rate hikes in 2016. So I don't think this is really a negative surprise or a positive surprise in that sense. The important thing for India now would be, what are the domestic triggers? So we have to look at what's happening to earnings growth, what's happening to reforms story, particularly GST, and on the global side, if you see some problems emerging in either the US high yield bond market or in emerging markets, the corporate sector debt has gone up quite significantly, particularly the foreign currency private sector debt in certain emerging markets. So you have to watch out for these 3-4 factors over the next few weeks. As far as earnings are concerned, do keep in mind that we will head into the quarterly season in the next 1 month or so. And I think you will still see some earnings downgrades during the course of the next quarterly season. So as of now, we are looking at about 20% earnings growth for the full year for March 17. I suspect, and based on whatever bottom-up analysis I have done, looks like it's going to more like 15%, which is still a very credible number compared to, something like 6% number, which will end up March 16 with. So net, based on all the factors that we're looking at, the US Fed event is out of the way. You will see some downgrades, which will probably keep the market, here for some time. But, as we go along, as we head into next year, I think the fundamentals are reasonably strong to see some positive returns in the next calendar year.
Just a doubt, you're going with 2017 20% or 15%? I didn't quite get you. 20%
for now, but looking at our assumptions, particularly on commodity prices, profitability for the cement sector, revenue growth for the industrial sector, I think there will be some earnings cuts over there.
Okay.
So if I just transpose the current spot prices, commodity prices, and then look at earnings growth numbers, I think it's more like 15% for now.
Okay, Sanjeev, hi, morning. It's good to read your report, which is titled Happier New Year. So after a forgettable 2015, you expect 2016 to be better. How does one really play this recovery in terms of themes and sectors?
Well, there are several themes actually for next year. One is clearly the economic recovery theme, which will start in the second half of the next calendar year. So I think private banks are a good play on that. Lower interest rates, I think the RBI has scope to cut 50 basis points next year. So I think you could look at regulated utilities such as NTPC Power Grid to play on the theme. And that is something which has been there for some time. I'm also quite positive on the financial savings theme, which again has been there for about a year or so. And I think that will continue for the next 5-10 years. So very positive on that part. And again, some private banks, offer reasonable opportunities as far as the financial saving growth part is concerned. So there are several themes, on the macroeconomic side. On the other sector-specific themes, you could look at higher crude prices towards the end of next year. I think the crude market is tightening going forward. Then you look at what's happening on the government's efforts to control air pollution, etc. And I think you will see a lot of developments in this area. Some of it is which is going to be negative for certain sectors and companies, and some of which could be quite positive for certain sectors, such as gas. I think would be eventually a big beneficiary out of all the government's efforts to eventually bring down air pollution in the country. Lastly, you will look at simplification of taxation regimes, both on the direct and indirect side. And again, you will see some winners and losers coming out of the GST changes that will happen, I guess, from April 117 now.
Okay, but Sanjeev, when you say 20% or 15% earnings growth, which are the areas or stocks in the index that might benefit? Or is this earnings growth largely to be seen in more non-index stocks?
No, this is for the Nifty 50 index, and similar for the BSE 30 also we have a similar number, and if I recollect correctly, for even the 170 stocks that we cover, we have a pretty similar number. So, the sectors where we are seeing a fair degree of growth is automobiles, and in that case specifically Tata Motors had a bombed out in numbers for the March 16 year, so you will just see some normalization of net profits over there. In fact, we're just looking at the 2017 net profits, being more or less equal to the 2015 net profits in that case, but it's still a big change from the 2016 numbers. Banking as of now for the Nifty 50 stocks, about 10 stocks over there, banking and NBFCs, we're looking at about 21% growth, and I think that is again reasonably achievable, unless and until the credit cost really surprised on the negative side. I think we are getting finally some handle on the NPL problem. Then we will have significant amount of growth in little bit on Reliance will have significant amount of growth. Then you will see some amount of growth coming through in technology, which is about 13% for now. And finally, utilities, we are looking at about 20% growth in both NTPC and Power Grid. So broadly speaking, you have reasonable number of sectors which will be closer to that 20% mark. Commodities would be a lot weaker. So broadly, we are looking at about 15% growth, assuming the kind of cuts that I was talking about earlier in commodity prices, etc. Factoring that, we are looking at about 15% for now.
Okay, I just wanted one follow-up on your view on banking, because even in private banks, the asset quality pressures have cropped up, and there is a lurking suspicion that the disclosures are not what they have actually been in the past. So which are the private banks that you would pick up in a situation like this?
See, I think the problems are largely known now. Which companies are the ones which have the most vulnerable balance sheets for now, and which banks have exposure to those entities. Having said that, I think without taking in specific names, there are solutions available for many of these larger groups which are known to be distressed assets, which have still not been recognized as NPLs in the books of the banks. In many cases there is a possibility of some other group entity being sold off to address the problem of the stressed company. There are enough number of cases in the larger groups. Again, if you look at some of the infrastructure companies, there are certain assets which are available which can be sold off, and at least the problem can be addressed for the next 2-3 years, I think, in some cases. So I am not as negative as I was on this entire space about 6 months, a year back. In the last 3 years we have been pretty negative on this one LPL issue, but I'm not that negative now because I think there are solutions available. Yes, of course there will be still some recognition which has to be done, but many of the banks have already taken a fair degree of provisions. I was just looking at SBI's numbers between 2012 and 2016, 4 years, the bank has provided for about 1.5% loan loss provisions every year now on an average. So that's effectively 6% of the loan book, taken care of in a way. So I think a lot of problems are getting addressed with some of the reforms on the being implemented by the government. So I won't be as nervous about the banking system as I was, I guess, even 6 months back. So the company that you should look at in that case, assuming we are getting to some bottoming out of the NPL problem, I will look at ICICI Bank a lot more favorably now. SBI, which is effectively trading at about 1 time price to book, if you adjust for about 50 rupees of the value of subsidiaries, 170 rupees adjusted book value for March 17, it's effectively available at about 1 time. Even ICICI Bank would be available at about 1.1, 1.2 on adjusted price to book basis. So I think a lot of bad news is getting priced in as far as some of these banks are concerned.
Fair point. I just want to know what would be your avoid sectors. Now that it looks like GST is going to be a stretch and a lot of the consumption names and logistic names were bid up in 2015 on these hopes, are those areas you would avoid at all? Staples?
No, see, that's more of a valuation call over there. I mean, GST is the positive for some part of the staples. Having said that, it's also negative for some of the staples where you have effectively no excise duty or very low excise duty as of now, which will go up. But in most cases, I assume this will be passed on to the consumer. What option do you have? If, for example, if on milk there is GST will presumably be there. Whether it is 12 or 18, we don't know for now. But if it is 12. I don't see I will be reducing my milk consumption just because the tax rate goes up. So I guess it's going to be passed on to the consumer in most cases as far as staples are concerned. The real benefit will come for, I guess, some of the companies or some of the sub-segments of consumer staples where the company is already paying tax rates which are above the GST rate. In some cases, the combined tax rate is more like 20 to 23% if you add the central excise duty of 12.5 and standard VAT rate of 12.5 to 14.5%. Obviously, the bases are different over here, so the combined rate would be closer to 22 or 23%. And if it goes down to, let's say, 18% under the GST regime, there will be some benefits to the companies. So some of the sub-segments of consumer staples would benefit, I think. Similarly, automobiles should be a big beneficiary. I know there are other issues now with this whole diesel tax, etc., coming up, but under the GST regime, something like UVs, which as of now attracts something like 40% combined tax rate between the excise duty and state VAT. If it comes down to 18%, that's a big winner over there.
Fair point, Sanjeev. Thank you very much for speaking about a bunch of micros and, of course, your macro position as well, which is a happier 2016. Hope the same for you too, if we don't speak with you up until the start of the next year. Thank you for joining us.
All right, we'll take a break on that note, but a battery of